Hi everyone, and welcome to my financial accounting YouTube channel. My name is Devin, and I'm so excited to be your TA this semester. In these videos, I'll be covering content from all of the chapters, and I'll also be going over practice problems at the end. As always, please feel free to reach out with any questions, and I'm looking forward to an amazing semester. Let's get started.
Chapter 1 is an introduction to business and accounting. A business is an organization in which inputs, or basic resources, are turned into outputs like goods and services, which are then sold to customers. The objective of most businesses is to earn a profit. So there are nonprofits and not-for-profits, but in this course we'll be focusing on for-profit businesses. Profit is simply the difference between amounts received from customers and the amounts paid for inputs. Or put a different way, it's revenues minus all of the expenses used to earn those revenues. In this course, we'll be looking at 3 types of businesses. The first is service businesses, which, exactly as it sounds like, provide services rather than products. So those could be airlines, entertainment businesses, etc. The second is merchandising businesses, which sell products they purchase from other businesses and then resell them. So that would be like a Target or a Walmart. And then third, manufacturing businesses actually create products and then sell them to customers. So that could be Ford, which produces cars, or Dell, which produces computers. And throughout the course, we'll go into each of these types of businesses in more depth. So, what is accounting? Accounting is an information system that provides relevant and timely information to users about the economic activities and conditions of a business. So, the process of accounting is pretty standard. It'll vary depending on who you are providing the information to, but the general process is first you identify users. So, is the information for management? Is it for investors? Is it for the government? Etc. Then you assess the information needs of the user. So what the government is looking for is different than what the management of the company is looking for. Based on this, you design the accounting information system to meet users' needs. You record economic data about business activities and events, and then finally you prepare accounting reports. And this is the final product that your user will end up looking at. There are 2 types of accounting. Managerial accounting provides internal users, so that would be managers or employees, with information about the business. And this is also known as private accounting. We won't be focusing on this in the course, as we will be focusing on financial accounting, which provides external users such as investors, creditors, customers, the government, etc., with information through general purpose financial statements, which we'll talk about more throughout the course. So, difference between managerial and financial. Managerial is internal and financial accounting is external. And then just some miscellaneous information. First, Sarbanes-Oxley. This is an act that we'll talk about more in Chapter 8, but basically it established a new oversight body for accounting after scandals with information reporting. So if you've heard of Enron, that was a company that did mark-to-market accounting and a lot of other fraudulent practices that resulted in a huge bankruptcy. And Sarbanes-Oxley was meant to foster public confidence and ensure the accuracy of financial reporting. The other item here is a certified public accountant or CPA. So the professors of this course are both CPAs, so that's important to note. And CPAs help individuals and companies with financial planning, investments, taxes, mergers and acquisitions, all sorts of things. They are certified by the board, and they can assist with a variety of topics. Okay. The generally accepted accounting principles, also known as GAAP, are a set of rules to follow when reporting financial information. So it's a standardized set of rules, and that is important because it allows for comparisons between companies. So everyone reports the same way. That means we can compare one business to another on equal terms. It's important to note that GAAP is established by FASB, the Financial Accounting Standards Board. That is different than the International Accounting Standards Board, but we're not going to be focusing on the differences in this course. However, you should note that if you're looking at an international company, there might be some differences in the rules. Some concepts here for you to know. First, the business entity concept. This means that businesses are viewed as an entity separate from its owners and creditors and other businesses. So if you are looking at a public company, so you're looking at Facebook, the owners of Facebook are technically the shareholders, so anyone that owns a share of stock in Facebook. But if you're suing Facebook, you're not suing each one of those individual shareholders, you're suing Facebook, the entity. And under the business entity concept, that's exactly what I just said. So businesses are viewed as an entity separate from its owners. Some forms of businesses. So throughout the course, we'll look at accounting for each of these different types. There's proprietorships, which is one person, partnerships, two people, corporations, which we'll talk about more in Chapter 13, and limited liability companies. We'll focus on all of these separately later in the course, but just important to know now that these are the main types of businesses. Another concept for you, the cost concept, is that amounts are initially recorded in the accounting records at their cost, so the purchase price. Regardless of asking price, market value, etc., you record the cost in your journals or ledger at the purchase price, and that's usually known as recording something at cost. Some related concepts that you can look up in the book are the objectivity concept and the unit of measure of concept. They're not as important, but I would look at them if you have the time. Okay, very important is the accounting equation. So it's made up of three parts. The first is assets, which are the resources owned by a business. So that's separated into the rights of creditors, so people who lend money, and the rights of owners, the people who invest money. Second is liabilities, and these are the rights of creditors. They are the debts of the business. So what does the business owe? And then owner's equity is the rights of the owners. So what belongs to the owners if we had to liquidate the business and sell off all the assets and pay off our liabilities? What is left for the owners of the business? This results in the accounting equation, which is assets equal liabilities plus owner's equity. And this always has to hold true. We'll talk about it more in the later chapters, but you should definitely memorize that assets equals liabilities plus owner's equity. So an example of how you might see this problem in a very basic way would be if assets increased by $50,000 and liabilities decreased by $25,000, what was the change in owner's equity? So we start with our equation, assets equals liabilities plus owner's equity. And then it tells us that assets increased by $50,000 and liabilities decreased by $25,000. What happened to owner's equity? So that's pretty simple. We see this $50,000 increase in assets, the $25,000 decrease in liabilities, and we solve for owner's equity. So that tells us that owner's equity increased by $75,000. Okay, a lot of definitions in this chapter. We're going to go through some more now. A business transaction is an economic event or condition that directly changes an entity's financial condition or the results of its operations. And it's typically stated in terms of changes in elements of the accounting equation. So a business transaction is really anything you can think of. It could be selling a good, so in that case you would have an increase in cash and an increase in revenue. It could be paying off a liability, anything like that. So now we're going to go into some of the terms that you'll be very familiar with by the end of the course. First is accounts payable. So this is a liability created by a purchase on account. So that would be if you bought something but you didn't pay for it with cash now, you said you were going to pay for it later. That's a liability because You didn't pay for it yet, you technically owe the seller money. Prepaid expenses, this is typically used with supplies. So a prepaid expense could be supplies used up in the business in the future. They're recorded as assets, but over time as you use them up, they are expensed because you technically paid for them in advance, but then you use them all up and then they turn into an expense. If that doesn't make sense now, that's totally okay. We'll talk about it in later chapters. Revenue is the money earned from selling goods or services. It can be written a lot of different ways depending on the type of business we're talking about. So fees earned is typically associated with service businesses, sales, interest revenue, rent revenue, etc. More terms for you. Accounts receivable is an asset from a customer purchasing a product on account. It's a claim against the customer. So this is the opposite of an accounts payable. In this case, you are the seller and your customer paid on account, which means they didn't pay you right now, but they're promising to pay you later. That's an asset for you because eventually you will get money from them. Expenses are assets used in the process of earning revenue. So those could be supplies used, payments for employee wages, utilities, other services, stuff like that. Owner's equity, we talked about earlier. Owner's equity is increased by investments and it's increased by revenue and it's decreased by withdrawals and expenses. Another important concept is that the effect of every transaction is an increase or decrease in one or more of the elements, and the two sides are always equal. So every transaction is going to affect the different accounts you saw here and some more that we'll learn about later. But what's most important is that the two sides of the accounting equation always have to be equal. So when you're trying to determine what happened, you need to make sure what you're doing to one side is equal to what you're doing to the other side. So as a simple example, we are purchasing supplies on account and we're trying to analyze what effect this has. So you can break it up into two parts. First, you think about what parts of the accounting equation am I looking at? So we have assets equals liabilities plus owner's equity. We're purchasing supplies, which is an asset, and we're purchasing them on account, which means we're not paying for them now with cash. We're going to pay for them in the future. So that is a liability. So in this case, we're purchasing supplies, so supplies are increasing. So on the left side of our equation, assets are increasing. And on the right side, we're purchasing them on account, so liabilities are increasing as well. So liabilities are increasing and owner's equity is staying the same. Assets and liabilities will increase by the same amount, so the accounting equation is balanced and equal. Okay, as I mentioned at the beginning, the end result of accounting for your external users is the general purpose financial statements. So the primary financial statements of a proprietorship are the income statement, the statement of owner's equity, the statement of cash flows, and those are all over a period. So you look at the income statement for the year, or you look at it for a quarter. It's what's happening to each of those elements over time. And then the fourth statement is the balance sheet, which looks at your assets, liabilities, and owner's equity as of a specific date. So that's just at one moment in time, what is the financial position of the company. So important to note is these three, so income statement, statement of owner's equity, and the statement of cash flows are all periodic. And the balance sheet is as of a specific date. The financial statements are prepared in the following order. So we prepare the income statement first, and the income statement reports revenues and expenses for a period of time based on the matching concept, which is the idea that we match expenses incurred during the period that revenue was generated. And that is really important. So part of what was happening with that company I mentioned earlier, Enron, was that they were reporting all of their revenue up front, but they weren't reporting any of the expenses. So if you do that, it looks like your net income is really high, but it's actually not, because you're not booking your expenses in the same period that you're booking your revenue. You need to do that, and you need to follow the matching concept so all of your information is accurate. And the end result of the income statement is net income or net loss, which, as I mentioned earlier, that's same thing as profit, is revenue minus all of the expenses used to earn that revenue. Next, after you prepare the income statement, you prepare the statement of owner's equity. So what this does is it reports changes in owner's equity for a period of time. It's prepared after the income statement because you need the net income or net loss, and it's prepared before the balance sheet because owner's equity is reported on the balance sheet. The statement of owner's equity is affected by investments, net income or net loss, and withdrawals. The balance sheet is prepared next, and it reports the amount of assets, liabilities, and owner's equity as of a specific date. So the balance sheet really is the accounting equation. And again, the important part here is it's a specific date. So on December 31st, 2020, what assets, liabilities, and owner's equity is the company reporting? And then finally, the statement of cash flows. That reports cash flows from operating activities, investing activities, and financing activities. And we'll talk about that again in chapter 16. So a lot of definitions there. That's mainly what the first chapter is. Now we're just going to do some really basic practice problems. Since it's mostly definitions, there's not a lot to ask about the first chapter, but it's important that you know those definitions, the name of the accounts, the different concepts in the accounting equation, because we'll build on that throughout the remainder of the course. So this first practice problem says that equipment with an estimated market value of $40,000 is offered for sale at $55,000. The equipment is acquired for $17,000 in cash and a note payable of $20,000 due in 30 days. The amount used in the buyer's accounting records to record this acquisition is, so here this question is asking us about the cost concept. And if you remember, it says we don't care about market value, we don't care what the asking price is, we only care about what we actually acquired it for and what we actually paid for it. So in this case, we acquired it for $17,000 in cash and a note payable of $20,000. So that just means we owe an additional $20,000. So the total amount we're acquiring it for is $37,000, and that is C. And that's a question about the cost concept that doesn't directly say it. Next, a business paid $10,000 to a creditor in payment of an amount owed. The effect of this transaction on the accounting equation was to. So here it tells us we are paying $10,000 to a creditor in payment of an amount owed. So what is happening here? Well, if we're paying $10,000 to a creditor in payment of an amount owed, we are decreasing a liability because we owed them that amount and now we're paying it off. So we can definitely say that we are decreasing a liability. And in order to decrease that liability, we have to pay the $10,000. So if we're paying $10,000 cash, that means our assets are decreasing as well, because cash is an asset and we are getting rid of it to pay off our liability. So the end effect is to decrease a liability and decrease an asset, and that is B. And then just a basic definition type problem. Which of the following financial statements reports information as of a specific date? So we talked about this earlier. The income statement is over a period. The retained earnings statement we haven't even learned about yet, so you shouldn't focus on that at all. If you're ever looking at a question and you don't recognize the term, it's probably because it's there to trick you or we haven't learned it yet. So don't doubt yourself. The statement of cash flows is also over a period of time. We know the only statement that reports as of a specific date is the balance sheet, which would be one specific point in time, the assets, liabilities, and owner's equity. So the answer here is D. That is all I have for you for Chapter 1. Pretty simple, but really important that you read through and start to get yourself familiar with some of the concepts. If you have any questions, please feel free to reach out, and I hope you have a great rest of your day.